Gail, way to go on the red shirt memo. Let's roll.
Yeah, red is the color of the day.
Red is the color of the day. It is Mojo Monday. How are you? How was your weekend? You enjoying life?
Life's good. Life's really good. Thanks for asking. Everything's going as well as it's supposed to. And the things I'm challenged with are the things I'm supposed to be challenged with.
Yeah. Well, this is one of my favorite parts of our week. You know, we do this Mojo Monday every Monday, and it's really our thought leadership opportunity to share how we think with everyone out there listening, and it's one of my special times of my week. We are going through the 6 myth understandings from the Millionaire Real Estate Agent book that Gary Keller put in. It's kind of all those things you think that are true that really aren't true, but you think they are, and you kind of trick your brain into thinking that way. And today's one of the real ones for a lot of people in real estate. You know, real estate is a business, and it takes money to make the business go round. And the myth for today is myth number 4, which says it's too risky, I'd lose money. And the truth behind that is risk is in direct proportion to how well you hold your incremental costs accountable to producing incremental results. What you say, Mr. Hale?
I mean, I'd start by saying that risk in general. So yes, it's all about ROI, return on investment, when it comes to whether something has, a risk that makes sense or doesn't make sense or is accountability based. But there's also the psychology of risk. And what I've learned after running around this earth 56 years as of, had a birthday recently, is that people are more likely to run from risk than towards opportunity. And so some of the, you started with the psychology of the mind and how we see and feel about things is that, at the end of the day, how you see and feel about it is how it is, regardless of reality. We create our own reality. But if you can, work towards recognizing opportunity as a magnet versus fear of risk. But the catch is, to your point, risk has to be held accountable, or it can also sink your ship,
It's a little bit like risk and fear are kind of the same word in some context, right? And you can't live your life absent of fear. And you can't succeed in business absent of risk. It's just, how do you not let it become so paralyzing to keep you from thriving in life around fear or thriving in business around risk, right?
Well, the simple answer, Brett, is you add the word calculated in front of risk, and it changes the dynamic of how your brain processes. Instead of it being emotional risk, if it's calculated, it becomes an intellectual risk. And that you can play out on a whiteboard with X's and O's, and it doesn't take over your heart and the energy of your body. It becomes an educated best guesstimate, if you will, or an educated process where you learn, good, bad, or indifferent about that investment, but you process it in an intellectually based way. And that changes the energy of that experience.
Yeah. So let's break that down, because I think that's really what this myth is about, is how do we not let it be a paralyzing thought, and how do we move to calculated risk? And I think what you talked about first, that I would put as like a first talking point, is you got to educate yourself. And if you're investing in something you know nothing about, you don't know if it's a good investment or not. Hence, it's probably going to be a little risky to you. You might strike luck, but the reality is you put your money into something you didn't have an education around. So whether somebody's investing in real estate or cryptocurrency these days is a newer one, or the stock market, or a business or a building, how do you educate yourself around that?
Well, there's a number of ways. Personally, the internet is a great resource for just scanning for evidence of where things have gone well. But, be careful also. There's multiple types of personalities, but one is the optimistic and one is pessimistic. If you find yourself in the pessimistic quadrant, you'll have no trouble finding reasons not to take a certain risk. If you search for it, it's that whole what you focus on expands. But if you're in the optimistic category, you have to be equally careful, because My mother wouldn't mind me sharing this, but she was a serial investor in multi-level marketing companies. I mean, she probably ran through 25 of them in my lifetime. And if I got a call probably once every 90 days, hey, I got a good one. I'm just going to put you in my downline. You don't have to do anything, but oh wait, they want you to hold your spot with a credit card. Yeah. And I end up storing, soap and stuff in my garage. Or
you grew up on Amway soap, right?
I did, man. I had a satellite dish in my garage once. It was the Inspiration Network or something that this is going to be the way of the future. The problem was it was pre-internet where you had to own a satellite dish to get it. And all that to say, you have to be careful if you're wired optimistically. And so 2 phases, one's education and research, the other is role models. The third is accountability and someone to look over your shoulder, as the proverbial devil's advocate or someone just to make sure you're not missing blind spots.
Yeah. And understanding the investment, right? And then also understanding what's the appropriate amount of money? What's the appropriate amount of money for the amount of money I bring in? So it's not how much am I spending, it's how much am I spending in relationship to how much I'm bringing in, which you use the term return on investment, but I'd also throw the term budget in here, right? Like
absolutely.
You have, it's kind of like life 101. You can't spend more than you make. Don't tell the credit card companies, but if you spend more than you make, it's not going to go good and it's risky. That's a risky way to live life. Business is the same thing. You got to hold your revenue accountable and create a budget around where you're going so you can hold these incremental costs accountable, right?
Well, when you set income goals and you benchmark it against a budget, it gives that subconscious and conscious brain room to play. You realize I've got margin in my finances. I've got 10%, 15, 30%. What amount are you going to invest this year, whether it's in your business, personal investment, or invest in something fun that you just, experience. And there's no flaw in that either. But if you forego the investment that gives you a return in a wealth building capacity, and you invest only in non-appreciating experiences and toys, at some point that recipe fails. And so you're right. Start with the waterline of your budget. And I think it was Mo Anderson who said you should, take your income, create a budget. 70% of your income should go to paying bills and running your business. 10% should go to tithing or gifting. 10% should go into savings and 10% into investing. That's a personal strategy. But interestingly, that does overlay well, even inside the economic model from Gary Keller, where 10% of your gross commission should go into a marketing budget. And it's sometimes hard to go find $10,000 inside of your current bank account to put into a marketing strategy, unless you have a predetermined plan where it's automatically deployed and tagged for that, where the psychology of that is an investment and it goes there. It's much easier to hit the button and send that money out, knowing that's part of a bigger plan. And then it comes down to red light, green light. And maybe you can share a little bit about what red light, green light means.
Yeah, well, I think what I'm hearing you say before I jump to that is I would use the term widen the perspective, right? Like if you're so focused in this one little tunnel, you can't kind of maneuver, where if you widen that perspective around your budget, around your goals, around, as you're saying, finding that $10,000. And if you commit to that at the beginning of the year and it's just a check you write every month, you created a wide enough perspective in your mind to where it doesn't feel risky, right?
Yeah.
And that's really kind of red light, green light, because red light, green light says, if my money is being held accountable and producing the results that I expect it to produce, which we'll talk about a number here in a minute, I should push the green light and continue to spend that money. But if my money is being spent and I know my numbers and I'm holding it accountable and it's not giving me the return on investment that I know through my education that I should expect, I should be playing red light and pull that back. And sometimes the economy does this to us, right? Like sometimes it's just the marketing. I mean, heck, the internet changes every 6 months right now, Rick. So what I'm spending my money on today may not be the right place to be spending my money 6 months from now. How many times has Zillow changed their model in the last 6 months? 6 times, right? Like it's crazy. So
Well, and to their credit, to be honest, they're adaptive and they're also recognizing trends, and they're clearly playing red light, green light, Brett. When you change your model 6 times or whatever the official number is, it says at some point someone in the back office raise their hand and say, "Hey guys, did you notice this chart, this graph, or this element of feedback? It's not serving us and giving us the return we expect." But they obviously knew what the expected return was to be able to throw up a hand and hit the red light.
yeah,
And then redirect that money to something that creates a better potential return. And sometimes people, it's a funny thing too. Just real quick on the psychology of investing. There are people out there that if I said for every dollar I give you, that you give me, excuse me, I'll give you $2 back. There are people that will hoard that dollar and for fear that it won't come back. But once you determine there is a path that creates a return, it's absolutely a foolish act to not invest so that you create a return. I mean, that's how wealth is built. And that's how businesses are built.
100%. And, the irony of this conversation, we're sitting here talking about Zillow and, we kind of poke fun sometimes or this, that, and the other, but they're actually playing a principle we're talking about here. They found themselves in a risky scenario around the Zillow offers and buying real estate, and they pulled it back, right? So here's the interesting question. How do I know it's being held accountable? Like, what's that look like? Like if you spent that $10,000, how do you know what's good, what's bad?
Well, there's a couple aspects to it. One is just a general return that you'd expect. I mean, like 12 Direct in the MREA book, if you send out a postcard once a month, 12 consecutive months to enough people, you should generate, one quality sale. So if you, just as an example, you send it to 500 people, you're going to spend $6,000 a year in that marketing campaign. You should expect at least one sale. And if your average sales price is high enough, you'll generate a return.
Yeah. I think the ratio on that's 50 to 1. So
50 to 1. Sorry, I said 12 to, that's 50 to 1.
1 sale. I don't know where we're going on that one.
No, it's actually going to be 50 to 1. So it should be 10 sales.
Yeah.
You should generate 10 sales at $6,000 a sale. If that's your average or it costs 6,000, you should literally get a 10 to 1 return if it costs 6,000.
Right. And the term I've heard is 4 times. So if I spend $1, I should get $4 in return in revenue on the dollar spent. Okay. So let me play that out for you for a second. A lot of people will say, hey, if I just sell one property, I'll cover my cost and it'll be a break-even, which is not a very strong business comment, because really it's just saying you don't understand holding your money accountable. You're just playing, you're minimizing the risk in your mind when you make that statement, instead of saying, hey, as a business person, I need to hold my money accountable to 4 times return. So for instance, if I said, Rick, I want you to spend $10,000 on your real estate business a month next year, a lot of people would get a little nervous in that conversation. And obviously there has to be a responsibility to you spending that amount of money. But if that $10,000 you were spending a month created $40,000 worth of revenue a month, that feels pretty good.
It does.
Yeah.
Anytime a 4 times return is awesome. And it's a great benchmark, but you've got to track and trend it. You also have to understand the time horizon for that investment. Back to that farming discussion, which you're exactly right. You should get, for every 50, you should get a sale. In that example, again, you should sell 10 houses if you send out, 500 people. And then you've got to realize it may not happen in the first year, but if it's a 50 to 1, if you can do a 4 times return, you've obviously rocked the percentages. And I would say even a 3 times, if you triple your money every year, probably not a bad idea, but you have to do it with some predictable fashion. And my advice is benchmark other people who are doing it inside, outside of your market area, and follow their strategies. And emulation is the greatest form of success strategy on the planet.
Absolutely. So 4 times makes sense, but learning and how to navigate and all this, whether it's 50 to 1 in a neighborhood ratio, all these numbers we learn in an educational process. Then we understand our life through a budget. And then we make the commitment and hold the money accountable. And it's not that it'll ever eliminate risk. It's that it minimizes it and holds your money accountable. So how do we challenge everybody this week, Rick, around this concept?
Well, I think you kind of gave me the layup. One is to create a marketing budget inside of your business plan. The other is create a personal budget so that you know where your watermark is to satisfy your core needs. And then don't skimp on growing and expanding your business. And that starts with a marketing budget. The second half is where do you want to deploy it that best suits your personality and style, and also the type of leads you get and your capacity to convert them. Not all leads are equally, valuable to the same person. And then the last piece is where can you elevate your awareness around being responsive is a big deal when it comes to generating opportunity, as well as the script required to create an intriguing conversation so that people want to have follow-up conversations that ultimately lead to opportunity to convert that investment into a return.
Awesome. I hope we inspired some people today to minimize the risk, hold their money accountable, and go big in business and in life and in investing in all things money related. Rick Hale, Mojo Monday, my friend.
Mojo Monday.
All right.
Yeah, ma'am.